HTJ.tax, the international tax firm for 6, 7, and 8-figure investors and entrepreneurs who are living that international life. Are you ready?
If someone has and I see where this person is in Australia and they want to set up, or they probably have already set up an LLC, a limited liability company in the United States. And there's this perception that once you form a company offshore, somehow you're magically going to save money. I guess all the movies and what Hollywood tells us. But that clearly is not going to save you any money. James?
Yeah. So, and this happens all the time. And people in Australia read, in the financial papers that, Apple don't pay any tax here. And the difference is Australia is, in a corporate chart, Australia is at the bottom. And in that scenario, all of the value that has been created is largely in intellectual property created multiple tiers upstream. And the entity that owns Australia is at the bottom. If valuable IP is created upstream, offshore, it can charge significant fees to the Australian entity, which pulls what would otherwise be Australian tax profit out of the country. So increases deductions in Australia, pushes up income in low or sometimes no tax jurisdictions. That is just the structure of the international tax system, because it was created actually between World War I and World War II in a completely different world. And all of the problems that we have in terms of base erosion and profit shifting, it's because it's very square peg, round hole stuff. The system is a very physical, or it's designed for a physical world, and we live in a digital world. If you flip it, and the directing mind, what we call the central management and control of a company is in Australia, and you incorporate an entity anywhere in the world, the definition of an Australian resident company is an entity or a company that is incorporated in Australia. So it's not that if it's incorporated in the US, Lithuania, or anywhere. Or if it's not incorporated in Australia, it carries on business in Australia, and it has its central management and control in Australia, which is high-level strategic decision-making, not the day-to-day ops or operations, or it has its voting controlled by Australian resident shareholders, which is invariably the case. So it's very easy for an entity that just incorporates, or an Australian individual that just incorporates a company overseas to render that foreign company an Australian resident for tax purposes. And that is because a couple of years back in 2016, there was a High Court case, and the issue was, well, if this is a two-pronged test, it carries on business in Australia and either central management and control or voting, then what constitutes carrying on a business? And that case essentially said, look, if you're making high-level strategic decisions, then at least in part you're carrying on a business here in Australia. So the same set of facts making decisions here, high-level strategic decisions here in Australia, can satisfy both of the two prongs, the carrying on a business and the central management and control. So that was the question. Well, is it a two-pronged test or is it a one-pronged test? It's just that one set of facts can satisfy both. Now, that was not necessarily intended. The High Court gave basically carte blanche for the ATO to really take everyone to town. To their credit, so far, they haven't done that. And the Treasury and the government have actually flagged that there will be changes to residency, because previously they said, carrying on a business, you actually looked at the operations on the ground. If you had a factory in Venezuela, even if central management and control was here, you weren't carrying on a business here in Australia, so you could that could legitimately be a foreign resident company. The problem with having a foreign incorporated company be an Australian tax resident is that it will pay tax over there in its source country, if there is corporate tax, which generally there is. It'll also pay tax here in Australia. Australia's corporate tax rate is high, so ordinarily even though Australia provides a credit, there will be a top-up tax, but you'll only generate tax credits, so franking credits or imputation credits, to the extent of the tax actually paid here in Australia. So if you paid 20% overseas and you're a 30% company here in Australia, you'd pay an additional 10% top-up tax here, but you'd only generate the $10 worth of franking credits, even though you paid $30 in tax. So that will push up your effective tax rate, because when a dividend is paid up to an Australian resident shareholder, it's only partially franked, and they will pay tax at up to 45% minus the maximum 10%. So they've got some significant top-up tax to pay. So yes, you can certainly just do that, but that's the first hoop to jump through. The second hoop to jump through, even if the foreign entity remains a foreign tax resident, is Australia's controlled foreign company rules. And Australia has essentially a high taxing Western alliance, really, where if you're a listed country, so we're talking the US, the UK, New Zealand, France, Germany, Japan, I think is on the list. Essentially, those listed countries effectively say, if you're carrying on a business over there and it's an active business, it's not a tainted business or a passive business, Australia won't tax you, as in the shareholder. If with very limited exceptions, what they call eligible designated concession income, which I've never actually dealt with that issue for the US, but the main one, for instance, say I incorporated a company in New Zealand, carries on business in New Zealand, but it makes a capital gain. New Zealand don't tax capital gains, but that is considered to be kind of CFC income, so it's actually taxed and it's attributed to me, as in the shareholder. It's an attribution regime. It'll tax me directly. So really, there's two hoops to jump through if you're wanting to successfully offshore. One, the residency issue, because a foreign incorporated company can very easily be considered an Australian tax resident. Although watch this space, because the legislation is changing. We're about to go through an election, so I don't know what the appetite is if that isn't squared away before the election, but certainly it's on the radar. The second hoop is, even if you jump through the first hoop successfully, is it a controlled foreign company? Or almost certainly, if it's a wholly owned subsidiary or it's wholly owned by me as an Australian resident, absolutely it's a CFC. The issue then becomes, does it have any attributable income? That depends on where the income is generated and the type of business or type of transactions that it enters into. And if there is attributable income, then say there's $100,000 worth of attributable income of my foreign company, I personally, as the shareholder, am taxed on that income.
Well answered. I think you covered everything there. And I don't know where it comes from, but probably just like you, I face this type of question multiple times every week. I guess somebody read something or they saw something on a movie, and they are convinced and they argue with me. I'm going to form this company and it's not going to be taxed. The money doesn't come back in. It's just, but you're right.
Well,
I mean,
that's a great point, because that structure, to the extent that it works, it relies on not being found out, and that's not a tax strategy. That's that's just criminal activity. I mean, it's
You'll be looking at four walls, a quadrangle.
If the linchpin of your strategy is not being detected, then you may want to rethink that strategy.
Exactly.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.